Have you ever stared at a stock chart,
Yeah.
watching those ups and downs, and just felt like there was something else going on, like a hidden pattern, maybe, a secret conversation you weren't quite hearing?
Mm.
What if those market swings aren't just random chaos? What if they're actually uh, carefully choreographed moves by powerful, unseen hands?
It's a fascinating thought, isn't it?
And how can you possibly tell if a sudden market recovery is the real deal or maybe just a really clever trap set up just to ensnare unsuspecting traders?
Yeah, that's the million-dollar question for so many people.
Well, today we're diving deep. We're unlocking the fascinating and, often controversial world of Wyckoff theory.
Right.
And this isn't just about, reading lines on a chart. It's about peeling back the layers, trying to understand the deep psychology and, well, the strategic manipulation that really shapes financial markets.
Exactly. It's about the why behind the price moves.
We're going to break down Richard Wyckoff's groundbreaking insights to help you hopefully decode what's really happening behind the scenes.
Let's get into it.
Okay, so to really get to the heart of this, let's start with the very foundation. How Wyckoff saw financial markets.
Okay.
I mean, at its core, a financial market is pretty simple, right?
Yeah.
It's where sellers and buyers meet, often running 200 to 4/7.
Sure, basic meeting place.
And the fundamental goal is profit from price differences. But for this huge continuous operation, for supply and demand to always be there, you need, well, colossal players.
Absolutely crucial. We're talking about the vast central banks, the big investment banks, those massive institutional portfolios.
They aren't just participants, are they? They're essential.
They are. And what's truly illuminating here is how this leads directly to what Wyckoff called the monopoly principle.
Okay, monopoly principle sounds serious.
Well, it's not about literal monopolies like in business textbooks. Instead, it speaks to the immense power these big entities wield. They possess the sheer liquidity, the ability to buy and sell enormous quantities to significantly move prices up or down.
So they can basically steer the ship.
Fundamentally, yes. Their actions are the cause behind the major sustained market shifts. Their goal, profit. And they achieve it by deliberately guiding prices to specific levels through their orchestrated buying and selling.
Wow. So this goes way beyond the simple supply and demand curves we learned in Econ 101, doesn't it?
Oh, definitely.
Wyckoff wasn't just observing. He was kind of adjusting the lens to see the true mechanics, recognizing these really powerful entities at the core.
Exactly. And from this deep understanding, Wyckoff came up with 3 fundamental laws he believed really govern market movements.
Okay, 3 laws. Let's hear them.
First, there's the law of supply and demand. Now, basic economics tells us, demand up, supply up, price down. Simple.
Right, the basics.
But Wyckoff saw a critical twist in financial markets. He realized these large institutional players can actively manipulate this balance. They can strategically create artificial demand to push prices higher or flood the market with supply to force them lower, all to hit their profit target.
So they can play with the scales.
You got it. Second, we have the law of effort versus result.
Effort versus result. Okay.
This law basically says that any price movement, the result has to be proportional to the effort put in. And in market terms, effort is usually volume, the quantity of shares traded.
Makes sense. Like pushing something heavy.
Exactly like that. Think of it like a coiled spring. If you see a lot of effort, really high volume, but the result is tiny, maybe the price barely moves, especially if the market's just chopping sideways for ages.
Yeah.
That's a huge tell. It means something significant is building up underneath. That long sideways consolidation or distribution phase, it isn't just quiet time. It's a powerful buildup of effort that's getting ready for a strong proportional price move to flat out.
Okay, so lots of activity, but no movement means pressure is building.
Precisely.
Yeah.
And finally, the law of cause and effect. This ties directly back to those market makers.
Right, the big players.
The fundamental cause of any substantial market move is always the strategic accumulation or distribution of supply and demand orchestrated by these dominant players. The result, well, that's a powerful, sustained, one-directional price swing.
Which brings us back to that first big question.
For you, the listener, when you look at market moves, are you truly seeing organic, spontaneous action? Or are you witnessing meticulously planned maneuvers designed by these market makers for their own strategic advantage?
That's a really critical distinction to make. Wyckoff further broke down these big market movements into 3 core phases: accumulation, distribution, and the trend itself.
Right, the life cycle.
Today, let's really unravel the first two, accumulation and distribution, because that's where the sophisticated stuff happens, right? Where the orchestration and the traps are set.
Absolutely. That's where the game is played.
Okay, let's break down this accumulation phase first. Picture this. The market's been in a long, maybe painful downtrend, or perhaps just drifting sideways with no direction.
Yeah, a frustrating time for most.
This is the quiet period. This is where the smart money, those institutional giants, are discreetly buying. They're scooping up shares without causing a big price spike.
Very quietly. Accumulating.
They're basically preparing for a massive upward move, trying to get the best possible entry points for the rest of us even notice anything's changing.
And Wyckoff saw this unfolding in 5 distinct phases. Phase A is the groundwork. It usually happens after a big downtrend looks like it's running out of steam.
Okay, phase A, what do we look for?
First, you might see preliminary support, PS. That's like an initial attempt to stop the fall, often with volume picking up a bit. Then comes the big one, the selling climax, SC.
Selling climax sounds dramatic.
It often is. It's a sharp, sudden price drop on the chart, looks really bearish. But critically, look at the volume. It explodes. Way more shares trading hands than usual.
So high volume on a sharp drop.
Exactly. It often signals panic selling by the public. Sellers are exhausted. After that, you get the automatic rally, AR, a strong bounce back up. This is driven by decisive buying, often the smart money stepping in, confirming buyers are now present.
Okay, so the panic selling is met by smart buying.
Right. And this rally then leads to a secondary test, ST. The price drops back down to retest that low point, the SC level. But usually this time, the volume is much lower.
Lower volume, meaning less selling pressure.
Precisely. It shows the selling is drying up.
So phase A, just to recap, it's like the market hits bottom, flushes out the last sellers, and then we see the first signs of big money buying, kind of like catching its breath after a fall.
That's a great way to put it. And as these big players keep maneuvering, we move into phase B.
Phase B, what happens now?
Here, the weakness in the old downtrend becomes really obvious. Often the downtrend line itself gets broken. The price pushes up, tests that AR resistance level we saw. But then it often drops back down again to retest the SC support level. And this retest, Wyckoff called it the first market trick.
A trick? How so?
It's designed to shake out anyone who's still nervous, anyone who thinks a downtrend might be starting again, make them sell right before the real move. The price might then go on to test the ST level again, just confirming that new support base is solid.
Okay, shaking out the weak hands makes sense. What's next?
Then comes phase C. Now, this is often the most critical phase and where the real deception can happen.
Okay, I'm listening.
After that secondary test, the price moves up again, maybe even reaches the second support level. But crucially, this is where the spring often occurs.
The spring, like a coiled spring.
Kind of, but think of it as the ultimate fake out. It's a false break below the last support level. A quick dip looks like the price is collapsing.
Oh, that would scare people into selling.
Exactly. It's designed specifically to trap those last sellers. But it's immediately followed by a strong, sharp rebound back above the support level.
Ah, so it dips below, then snaps back fast.
Right. And that powerful rebound after the spring, that confirms the cause for a major upward move is now really locked in. All the weak sellers have been flushed out.
That's fascinating. So if I'm picturing this, the spring is like the market taking one last deceptive dive just to make absolutely sure everyone who might sell does sell before the real rocket takes off. Key insight for you listening. This spring often signals the ideal low-risk entry point for a big move up. Don't fall for that fake breakdown. Look for the strong rebound.
Precisely put. And after that decisive spring, we transition into phase D.
Phase D, getting closer to the trend.
Yep. Here, the price decisively breaks above the resistance levels established earlier. And importantly, it successfully retests them, turning old resistance into new solid support. This marks the undeniable start of a strong, sustained uptrend. You'll start seeing higher highs and higher lows.
The classic uptrend pattern begins.
Exactly. And finally, phase E is the last phase. The price just continues its strong, sustained upward climb, riding the wave of the cause built during all that accumulation.
So this is where you really want to be in the market.
Ideally, yes. This is the preferred stage to be fully invested, focusing on what traders call demand zones, because the market is clearly in the hands of that smart money driving it higher.
Okay, so what's the critical takeaway from understanding this whole accumulation process? Your biggest edge here is knowing that those deep, scary-looking dips after a long sideways period, they're often orchestrated buying opportunities, not reasons to panic sell. Look for those springs, that fake breakdown, followed by a strong recovery as your final confirmation. It's a flashing sign the market might be prepping for a major reversal.
Absolutely. And it highlights why flexibility is so key with Wyckoff. The market isn't static, it's dynamic, and these patterns are literally designed to deceive the average trader and flip the direction.
All right, now let's flip the script. Let's look at the distribution phase.
Okay, the other side of the coin.
This is the market getting ready to offload assets, usually after a big run-up, right?
Right.
Signaling a coming downtrend.
Exactly. It's essentially the mirror image of accumulation. The big players are now quietly, strategically selling off the positions they accumulated earlier, selling them to unsuspecting buyers who are jumping in late.
And I assume this also has phases.
It does. Just like accumulation, distribution typically unfolds in 5 distinct phases. Phase A happens after an uptrend or maybe a long sideways move at the top. You'll first see preliminary supply, PS, or resistance forming, an initial sign that selling is starting to come in.
Okay, PS. Then what?
Then comes the buying climax, BC, another critical and deceptive point. This looks like a really strong bullish candle, maybe breaking to new highs. But again, look at the volume, ultra high volume.
High volume again, but this time at the top.
Right. It indicates excessive buying, often driven by public euphoria, FOMO, fear of missing out. But it's actually where the smart money starts heavily unloading. This is followed by an automatic reaction, AR, a sharp drop caused by that initial wave of institutional selling.
So the party stops suddenly.
Pretty much. And finally, a secondary test, ST, where the price tries to rally back up to retest that BC high point. But often, this happens on lower volume, showing that the real buying interest is fading.
Got it. Less enthusiasm on the retest. What about phase B?
In phase B of distribution, the uptrend shows clear signs of stalling. The uptrend line often breaks. The price might test that AR support level from phase A, bounce a bit, then try to climb back towards a BC resistance level.
Another test.
Yes, and this retest is often another market trick. It's designed to make hopeful buyers think the uptrend is just pausing and about to resume. They buy in, only for the price to roll over and drop again. This phase is usually choppy, volatile, as the smart money is systematically distributing, selling their shares into any rallies.
So lots of failed rallies and churning.
Exactly. Then we get to phase C in distribution, and this is where a really significant trick often happens.
Okay, another trick.
After some volatile downward moves, the price might climb back up near that first support level, which is now acting like resistance. Sometimes it even breaks above a recent resistance level in what's called an upthrust, UT. Or it might just rebound strongly towards the highs without actually breaking them.
An upthrust. Sounds like the opposite of the spring.
It essentially is. This phase can include something called a UTAD, an upthrust after distribution. This is a clear false breakout above resistance. It looks super bullish for a moment.
The final trap for buyers.
Precisely. It's designed specifically to trap eager, late buyers, make them think the price is going to the moon right before the real markdown, the real downtrend begins. It's the final shakeout, letting the big players unload their last shares onto the unsuspecting crowd.
Okay, so for distribution, the UTAD is the danger signal. That false breakout upwards. Key insight for you. If you see price break convincingly above a resistance level, only to fail quickly and fall back below, especially on high volume, that's probably not a bullish breakout. That's likely the smart money creating exit liquidity for themselves. This could be your last, clearest warning sign to get out or even prepare for a short position.
Couldn't have said it better.
Yeah.
Then phase D sets in. After these repeated tricks, the price starts consistently forming lower highs and lower lows. You'll see fluctuations, maybe bounce off support levels, but eventually those support levels break decisively.
The trend clearly shifts down.
Right. Sometimes there's a little retest after the break, confirming that old support is now near resistance. At this point, the uptrend is undeniably over.
And phase E.
Phase E is the final phase, where the price continues its strong, sustained downward movement. This is the markup phase and reverse the markdown. This is the preferred stage to be selling or shorting, focusing on supply zones, as the cause built during distribution now yields its powerful downward effect. Wow.
Okay.
And if we connect this back to the bigger picture, understanding this whole cycle of, well, deception is just crucial for avoiding potentially huge losses. It's worth noting, though, sometimes accumulation and distribution can be quite small, quite compressed. They might not show every single one of these detailed phases perfectly.
Right, the market isn't always textbook.
Exactly. But the underlying principles, the smart money accumulating low and distributing high, using tricks to shake out the crowd, those remain constant.
That raises a really practical question, though. Given all these subtle cues and potential tricks,
Mhm.
when is the absolute best time to act on these distribution signals? How do you really know, okay, now is the time to exit along or maybe even think about going short?
Yeah, that's the million-dollar timing question again, isn't it? Well, the timing of distribution, it often happens near previous areas where distribution occurred on the chart, or significantly at major supply zones seen on higher time frames, daily or weekly charts, perhaps. That gives it more context.
So looking at the bigger picture helps.
Definitely. It's also important to distinguish true distribution, signaling a major top, from maybe just a healthy pause or even reaccumulation within a larger uptrend. But generally, the best time to consider selling or getting out is when that uptrend clearly breaks early on, especially around that automatic reaction AR level. Or, crucially, when a clear sign of weakness, SOW, appears. This often happens at what Wyckoff called the last point of supply, LPSY.
Last point of supply,
Right.
LPSY.
Right. That's often a final, weaker rally attempt that fails, confirming the sellers are now fully in control and the downtrend is likely taking hold. That LPSY can be a prime spot to act.
This whole concept of market psychology and these subtle tricks the market makers play, it really reminded me of something we explored in more detail in a previous deep dive.
Oh, yeah. Which one?
We looked at the broader psychological aspects of market behavior, things like cognitive biases, and how they can make us, as individual traders, really susceptible to falling for these exact kinds of patterns Wyckoff described. If you're curious about that side of things, definitely check out that episode. It adds another important layer here.
That sounds like a great companion piece to this discussion. Understanding yourself is as important as understanding the market sometimes.
So true. Okay, let's try to wrap this up. What's the big takeaway from our deep dive into Wyckoff today?
Well, I think the main thing is Wyckoff theory isn't some magic crystal ball, right? It's not about predicting the future with absolute
Oh,
certainty.
well, no guarantees in the market.
Exactly. But it is an incredibly powerful framework. It helps you understand the underlying forces, the intentions, and the orchestrated moves behind major market shifts. It gives you a lens to identify when those big players might be quietly accumulating assets for a push higher.
Or when they're strategically distributing them before a significant fall.
Precisely. And that understanding helps you avoid getting caught on the wrong side of a major trend reversal. It can help turn those potential pitfalls into actual opportunities if you know what to look for.
Yeah, it's about reading the narrative the chart is telling.
And while there are no absolute constants in the market, really digging into these patterns helps you see beyond just the surface noise. It empowers you to think critically, to question your own assumptions, and to consider different viewpoints on why the market is doing what it's doing, instead of just reacting emotionally or to headlines.
That critical thinking piece is huge.
It is. This knowledge is most valuable when it's truly understood and then applied thoughtfully. It can give you a distinct edge in a game that's often, let's be honest, designed to trick the average participant.
Definitely food for thought. And as you reflect on today's deep dive, here are maybe some deeper questions for you, the listener, to ponder. First, how often do we interpret complex patterns in our own lives as just random events when maybe, just maybe, they might be carefully orchestrated by influential forces or hidden agendas we don't immediately see?
Ooh, that's a deep one.
Second, what unconscious biases might you unknowingly hold that make you more susceptible to being tricked? Not just in the financial markets, obviously, but in other areas where information is presented to you, maybe in the news or advertising.
That requires some real self-reflection.
And finally, how can this ability, we've talked about the ability to identify these underlying causes and effects, this deep decoding skill, how can that empower your decision-making, not just in your finances, but in navigating the much broader world of information and influence all around us?
Powerful questions indeed, applying market lessons to life.
Now, if all this talk about Wyckoff, accumulation, distribution has really sparked your interest in truly mastering trading and investment strategies, well, we wanted to mention there's actually a professional course available designed to teach you from scratch. It covers everything you need to know to become a more confident trader.
Yeah, getting the fundamentals right is key.
And speaking of navigating these market dynamics, we know finding reliable tools is also crucial. Look, due to the unfortunate proliferation of, frankly, fraudulent trading platforms out there,
Yeah, it's a real problem.
we wanted to highlight a secure and global platform for trading and investment that we've looked into and found to be really excellent. You can trade stocks, gold, forex pairs, lots of different markets. It's incredibly fast for deposits, for withdrawals, which is important. And they even offer a 50% bonus on your first deposit.
That's a nice incentive.
So you'll find links to both the course and this trading platform, along with, of course, the original sources that inform today's deep dive right there in the description below.
Definitely check those out if you're interested.
And hey, if there's a specific topic you'd love for us to deep dive into next, something that's really sparked your curiosity, please let us know in the comments below. We love getting suggestions.
Yeah, we do.
If you found this deep dive valuable, insightful, maybe even a little eye-opening, don't forget to subscribe to the channel. That way you'll catch all our future explorations.
Stay curious.
We're always unearthing fascinating new topics for you, so definitely stay tuned for our next deep dive. And of course, if you missed any of our previous explorations into complex subjects, they're all there in the archive waiting for you to discover.
Thanks for tuning in, everyone.